In recent years, American agriculture has faced one of its most significant failures in history. In 2023, U.S. agricultural exports to China fell by 24%, which is estimated to be a staggering $29.01 billion of loss. A single shift in trade policy by China in 2018 has disrupted the backbone of U.S. farming. U.S. farmers are confronting a reality in which one of their biggest customers is now looking elsewhere, turning instead to Brazil, Argentina, and other nations to meet its agricultural needs. This pivot by China is not just a short-term adjustment. It's a calculated, strategic shift with long-term consequences for the U.S. agricultural sector. In this video, we will explain how China has been able to decrease its dependency and disrupt US agriculture. For years, China was not just a customer, but the single largest buyer of certain U.S. agricultural products. In 2017, China purchased nearly $24 billion worth of U.S. farm goods, with soybeans alone accounting for over $12 billion of that amount. China's demand was so significant that it bought around 60% of all American soybean exports annually, along with a large share of U.S. pork and corn. The scale of this market meant that many U.S. farmers could rely on a steady, predictable income. Between 2010 and 2017, U.S. agricultural exports to China averaged around $20 billion a year. This steady demand stabilized crop prices and kept farm revenues reliable. However, this dependency came with a risk. By putting so much faith in a single market, American farmers left themselves exposed to potential shifts in Chinese policy. The first sign of trouble came in 2018 during the trade tensions between the U.S. and China, when the U.S. imposed tariffs on Chinese goods.
Shortly after Washington unveiled a list of Chinese imports to be hit with tariffs, Beijing responded retaliation using similar measures against American goods, specifically targeting soybeans and vehicles.
China retaliated with a 25% tariff on American soybeans, making U.S. soybeans significantly more expensive. U.S. soybean exports to China plummeted to just 8 million metric tons in 2018 compared to 32 million metric tons the previous year. It is estimated a decrease of almost 75%. By 2023, the ripple effects of that initial shock had compounded, and Chinese demand for U.S. agricultural products had reached one of its lowest points in decades. For many farmers, this sudden reduction in demand created a surplus of crops that they could not easily sell, leading to a steep decline in prices. For example, soybean prices dropped from around $10.50 per bushel in 2017 to roughly $8.50 per bushel in 2019, a decrease that slashed revenue across the industry. These losses translated into billions of dollars in lost income for farmers, many of whom had invested heavily in infrastructure, equipment, and land based on the assumption that Chinese demand would remain stable. The impact of China's trade pivot has not been limited to farmers alone. Rural economies across the U.S. have been hard as well. Agriculture is the primary economic driver in many rural communities, and when farm income drops, local businesses and services feel the effects. In areas like the Midwest and the South, where agriculture forms the economic backbone, the decline in Chinese demand has led to a noticeable reduction in local spending and economic activity. For example, the USDA reports that for every dollar spent by a farmer, around 60 cents goes directly into the local economy. This money supports a range of businesses, from equipment suppliers to grocery stores and local diners. But as farm incomes have dropped, farmers are spending less, and local businesses have seen their revenues decline. Equipment suppliers who sell tractors, combines, and other machinery have seen a reduction in sales as farmers postpone major purchases. In states like Iowa, where soybean farming is a central industry, equipment dealers have reported sales drops of up to 20% since 2018. As revenues have fallen, U.S. farmers have been forced to rely more heavily on loans and credit to keep their operations afloat. Farm debt in the U.S. reached an all-time high of almost $500 billion in 2023, with a significant portion of this debt held by farmers who have seen their incomes shrink due to reduced exports to China. Many farmers have taken on additional debt to cover costs like seeds, fertilizer, and equipment repairs, as well as to pay off existing loans. But how all these problems started? The trade war that began in 2018 marked the beginning of China's gradual shift away from U.S. agriculture. When the U.S. imposed tariffs on Chinese goods, China retaliated with tariffs on American agricultural products. The 25% tariff on soybeans made U.S. soybeans significantly more expensive, leading China to seek alternative suppliers. While the tariffs have been reduced over time, the damage to U.S. China agricultural relations was already done. Since then, China has actively worked to diversify its agricultural imports, reducing its reliance on U.S. farmers. Brazil and Argentina have stepped in to fill the gap, with Chinese imports from these countries increasing dramatically. In 2023, China imported around 57 million tons of soybeans from Brazil, compared to only 16 million tons from the United States. This shift is supported by Chinese investments in Brazilian and Argentine infrastructure, including ports, railways, and processing facilities, which have made it easier for these countries to export agricultural goods to China. Argentina, too, has seen a surge in exports to China, particularly in corn and beef. In 2023, China imported over 12 million tons of corn from Argentina, filling a demand that was once largely met by U.S. farmers. China's long-term contracts and infrastructure partnerships with Brazil and Argentina have created a supply chain that reduces the likelihood of China returning U.S. agricultural products in the near future. This shift to competitors has created a lasting impact on the global agricultural landscape, positioning Brazil and Argentina as major players in markets that were once dominated by the United States. With China's shift away from U.S. agricultural products, American farmers face an uphill battle in finding new markets and combating growing competition from other countries. China's decision to scale back its purchases from the US left American farmers scrambling to find replacement markets. Although countries in Southeast Asia, Africa, and South America present some opportunities, the size and buying power of these markets is too low in comparison to China's former demand for American goods. The U.S. Department of Agriculture has attempted to open new markets in Southeast Asia, targeting countries like the Philippines, Vietnam, and Indonesia. But these nations, while growing economically, cannot match China's vast import needs. Southeast Asia's total agricultural import demand is around $40 billion compared to China's $160 billion in 2012. Even if the US captured a significant share of these smaller markets, it would not fully replace the scale and profitability of the lost Chinese demand. Moreover, logistical challenges make it harder for U.S. exports to penetrate these new markets. For example, shipping to African nations involves longer and costlier routes, reducing competitiveness. Countries in South America, such as Brazil and Argentina, are geographically closer to some of these markets and already have established trade agreements, creating additional barriers for U.S. farmers. According to a report by the U.S. Grains Council, American agricultural exports to Southeast Asia grew by just 5% in 2023, a small gain that barely makes up for the $29 billion drop in exports to China. Compounding these issues is the fact that these emerging markets have unique demands and preferences, which do not always align with U.S. agricultural outputs. For instance, in countries where rice is a staple crop, demand for corn or soybeans may not be as strong, forcing U.S. farmers to adjust their production if they hope to capture these new markets. These structural and logistical obstacles mean that even the most optimistic growth projections in new markets fall far short of offsetting the loss of China as a primary buyer. As the US faces challenges in securing alternative buyers, Brazil and Argentina have aggressively expanded their agricultural exports to China. This shift has fundamentally altered the competitive landscape, making it harder for US farmers to sell their products globally, even in markets outside of China. Brazil's soybean exports to China surged to approximately 57 million tons in 2023, compared to only 16 million tons from the USA. This growth was not accidental. China has invested heavily in Brazil's agricultural infrastructure, financing improvements to Brazilian ports, railways, and processing facilities. These investments have lowered transportation costs and reduced the time it takes for Brazilian soybeans to reach Chinese markets, giving Brazilian farmers a distinct logistical advantage over their American counterparts. Argentina has seen similar growth in its exports to China, particularly in corn and beef. Argentina's corn exports to China exceeded 12 million tons in 2023, compared to a declining share from the U.S. Additionally, Argentine beef exports to China have risen sharply, with China now accounting for over 75% of Argentina's beef exports. With such a large portion of Argentina's production going to China, U.S. beef producers have lost a valuable market, forcing them to compete in regions where demand may be weaker and prices lower. The competitive pressure from Brazil and Argentina is exacerbated by their lower production costs. According to data from the International Grains Council, the cost of producing soybeans in Brazil is nearly 30% lower than in the US. These cost advantages allow Brazil to sell its products at lower prices, which is appealing to Chinese buyers looking for affordable imports. As a result, US farmers are forced to lower their prices in other markets to compete, further eroding their profit margins. The rise in exports from Brazil and Argentina has not only intensified competition, but has also contributed to lower global commodity prices. The expanded production capacity in Brazil and Argentina, combined with China's decision to favor these suppliers, has created a surplus in the global soybean and corn markets. This oversupply has driven prices down, making it increasingly difficult for US farmers to sell their products profitably. In 2023, global soybean prices fell by 8%, according to the International Grains Council. This price drop is directly tied to the increase in Brazilian and Argentine exports to China, which have shifted the balance of supply and demand. Lower global prices force US farmers to sell their products at reduced rates, impacting revenue and contributing to ongoing financial strain. Corn prices have seen a similar decline, falling by around 10% as Brazil and Argentina have ramped up production to meet Chinese demand. The future of U.S. agriculture, in light of China's pivot to alternative suppliers, appears challenging and uncertain. With China now relying more on Brazil and Argentina, American farmers face a shrinking market and rising competition. The USDA estimates that without a rebound in demand, the U.S. farm's income could decline by an additional 10% over the next 5 years. Combined with nearly $500 billion in farm debt and rising interest rates, these conditions make it increasingly difficult for farmers to cover costs, let alone invest in their operations. For smaller and mid-sized farms, this financial strain raises the risk of bankruptcy or consolidation into larger corporate farming operations, which could change the landscape of American agriculture. At the same time, the industry's future may be further impacted by slowdowns in innovation and generational change. Agricultural research funding has decreased, limiting advancements in sustainable practices, climate-resilient crops, and productivity-enhancing technologies. This lack of innovation could weaken US competitiveness globally, especially as other countries, such as Brazil, make strides in agricultural efficiency. Furthermore, the high costs of entering the farming industry are discouraging younger generations, leading to an aging farmer population with fewer young people ready to continue the work. Without fresh investment, a focus on innovation, and support for new farmers, U.S. agriculture may struggle to adapt to a changing global economy.